Good afternoon, everyone. David Crowd Jr. here, President of Succession Resource Group, welcoming you all to our session here today titled 2020 Advisor M&A Review. Really excited to have so many of you joining us here. Humbled you were kind enough to take time out of your busy schedules, especially here in January for our session. We love doing these sessions. Every year we put together all of our data, have our analysts go through and pull out the most interesting trends, most interesting data points so we can share it with you. This is, at the end of the day, our data, but this is wisdom of the crowd. And what's even cooler this year is the data set hasn't ever been larger because contributing to both our session today, but more importantly, also contributing to the data was both Live Oak Bank and PPC Loan, who are joining us here today as panelists. So they're going to share some of their insights. They've been kind enough to share their data. So what we've got to kick things off here is a really good cross-section of information from across the industry. So you got data from the deals that we worked on, which fall into two different categories. You have both the deals we worked on as an intermediary, and then you got the deals that we worked on as an advocate for either the buyer or the seller. And then you got the information from PPC Loan, from Live Oak Bank. We also have some contributing partners from some of our broker dealers and custodial partners, some third-party asset managers. So anyway, it's a large data set now for the industry as a whole on buying, selling, mergers and acquisitions, almost entirely of the advisor population below $1 billion in AUM. There's a lot of information out there that you'll see in the various trade publications on what's happening out there for buying and selling kind of the mega RIAs. You see the big broker dealers, and occasionally one of the really big kind of super OSJ sales will come up in the trade pubs. But you don't really see a lot of information out there on the normal advisor, put quotes around it, but the normal advisor, the people that you are talking to at conferences, that we all bump into at the FPA chapter meetings, that myself, our consultants here, that John and Dustin talk to literally every single day. And that's what we get to bring back to you here today. So without further ado, I'm going to dive right in because we've got a lot of really good content for you. I know Dustin and John both have some good insights that they're excited to share. To kick things off, for those of you that maybe haven't actually attended one of our sessions before, I know I've seen some names on here that we haven't had a chance to work with. Succession Resource Group is a consulting organization, our firm, that is dedicated to helping advisors buy and sell their businesses, is the short version. But over the years, we've backed up from just the exit door, helping folks with succession and retirement planning, to start working on things like equity sharing plans and entity and employment resources, things to help make the business more ready to acquire, more ready to sell. So that's what we do in a nutshell. We've been doing it for since 2012, so we're heading towards a decade now. I've been doing this back to the early 2000s. John Turner has been doing this since the early 1900s. You'll see his video feed here shortly. And then Dustin Mangan, who's joining us from PPC Loan, has been doing it for a very long time as well. I think as long as I've been doing it. We've been working together for a long time. So before we dive into the content, I also wanted to just share what we got coming up in just Q1 of 2020. More to come in the rest of the year, of course. But in February, we have our other kind of big webinar that we'll do this year. It's our RIA M&A Decade in Review. So looking back over the last 10 years and then projecting out what we expect in the next 10. We don't have the date firmed up for that yet, but it should be mid-February. We've got some really great panelists on par with the two that we've got here today. So I think you'll really enjoy that one. We also have our infographic. We issue it every year. It's just a really core set of data of the most interesting and cool data points from mergers and acquisitions last year. So I'll have that out here shortly. And then, of course, we've got the practices that are for sale that most people want to at least be aware of. That all comes out. The webinar notifications, like the Decade in Review, the infographic, practices for sale, all that comes out through our email notification system. So our moderator here today, David Pan, will be sharing that in the chat section. So feel free to use along the bottom portion of your meeting here today, you'll see this Q&A panel. feel free to use it. I'll be keeping an eye on it and asking questions or answering questions from you that come up throughout the presentation. We'll also get to the ones at the end that we don't have time for during the presentation. But we'll also be sharing some links with you down there in the chat portion. So without further ado, let's dive in and get to our content and our agenda and our panelists. So there's me on the far left. You'll see the video feed from John Turner and Dustin, both as they share their insights today. All three of us are available. We'll make sure in that chat window, if you do have it up or if you end up bringing it up, that you have our contact information. You can also obviously find us on social media. You'll see the link for each of the three of us there. I know all three of us are happy to answer any and all phone calls that you may have, both today and in the future, so don't hesitate to reach out. But we will try to get to as many of the questions that you have today as possible. Quick snapshot of our agenda. I want to start with a market status, just general overview. What's happening out there for buying and selling the practices. Then we'll get into the deal specific stuff. We'll talk about valuation trends, buyer trends, because we talk a lot about what's happening with the sellers, value of practices, how the deals are getting financed, which is a key part of the trends that we'll share today, which is why we have both Dustin and John joining us. And then we'll button things up with our market outlook for 2020. And then, like I said, if you want to know more our perspectives for the next decade, a little bit more holistic perspective, like I said, get signed up for our notifications and we'll make sure to invite you to our decade in review session that we got coming up here shortly. So, market update, what's happening out there that was noteworthy from 2019? Demand has remained incredibly strong throughout 2019. A lot of this kind of goes back to the financing that has become available. There has always been a lot of buyers. I mean, it's always been 30, 40 buyers for every single seller that we have. And that's a nationwide average. Some states are higher, not many are much lower. But the demand has been very, very strong in 2019, bolstered by the bank financing. Where historically buyers had to plan to bring 10, 20, maybe 30% cash down to get a deal closed. You know, if you're thinking about buying, let's just say a $500,000 all fee RIA, simple, let's say 2 times multiple to keep my math simple, that's $1 million business. If you had to bring 300,000 to close, that excludes some buyers that just don't have the capital. They're not ready when the opportunity presents itself. The nice thing is with the bank financing that's available nowadays, all those buyers or a lot of those buyers are actually back at the table. They have a shot at it because there's a lot of financing available that could result in them not having to bring anything to close. We had a question from one of the attendees, and I know we'll get it again, so I'll just answer it now real quick before I move to our next bullet. And it's just, will the slides be available after the session? You bet they will be. Both the recording will be up live within a day or two usually. And then if you'd like a copy of the slides, we'll send that PDF of that out as well. My next bullet here is practices remain undervalued. This is an interesting one because when we talk to buyers, and by we, I mean all of us here today, Dustin, John, myself, but the rest of our team here, their teams, most of the buyers that we'll talk to will have a very different opinion. The practices are significantly overvalued. So why would I tell you practices remain undervalued? Well, again, this goes back to the financing that's changed here in the last 24 to 36 months. Historically, and I'll keep this part short because we will get to the deal section, but the primer on this one is deals practices are undervalued mainly because when you look at the cash flow of deals, let's say 5 years ago, if I was in 2015 and I was going to acquire that $500,000 RIA and I paid $1 million to get it, I would pay $200,000 or $300,000 cash at close, and I'd pay the other, let's say $700,000 or $800,000 out of cash flow over maybe 3 to 5 years. 5 if I was lucky, 3 being more typical, sometimes 4. But rarely would it go longer than 5 unless we were somehow buyer and seller related. And even then, frankly, it usually was 3, 4, maybe 5-year financing. So when you have cash flow constrained by the financing and there's no banks available to lend on it, of course the value stayed in the 2.3, 2.4 range. As soon as you take those constraints off and say, okay, well, I don't want to steal Dustin or John's thunder about their financing, but when you can finance it, let's just say over a longer period of time, all of a sudden the cash flow on that same deal gets a lot better. And if I could finance it over some period that's maybe longer than 5 years, hypothetically, let's say 10, all of a sudden paying $1 million over 10 years and not having to bring any cash out of pocket, well, I tell you, the practices are undervalued. And while market conditions aside, the actual multiples are likely going to continue to increase. We're also seeing the down payments increase. They go up every single year, especially, again, due to the bank financing. I'll share more on that later, but we're seeing a ton of all cash deals. I mean, when I say all cash, obviously we've got to caveat that. The buyer's borrowing all the money from, let's say, Dustin or John, Live Oak PPC loan. They're putting a portion of that, sometimes in escrow, sometimes it all goes to the seller. But it is an all cash deal in that while there may be a contingency on it, the buyer's borrowed all the money. So as long as the seller delivers, they're going to get all of that cash. And in many cases, they are just all cash deals, no escrow. So all cash deals becoming more common. You're seeing much higher down payments. Again, it goes back to the bank financing, which John and Dustin will share more on later. We're also seeing an interesting trend on the overhead that's been assumed. Historically, buyers usually would, of course, buy the business, the clients, the revenue, the assets, but they didn't usually take on a lot of additional overhead from the seller. Occasionally, a key staff member if the seller really made it a requirement. But now we're seeing elongated transitions where sellers are involved for 2, 3, sometimes 5 years. They're keeping the lease, they're bringing on staff. And again, I would tell you a lot of this is going to point back to the bank financing or just in general, the increased available cash flow on these deals. Buyers have more flexibility because there's more cash left on the table. So it's been interesting to observe over the last couple of years. So as we then get to the next portion that I want to share with you here, and that is looking at the deals that were advocated versus self-negotiated. We do a lot of deals where we work as an intermediary. We also have a bunch of deals where we work just on, let's say, the sell side. And I want to compare the two because there are some noteworthy differences here. I'll just put the few bullets up that I wanted to share. Values, when there's somebody actually advocating, besides the owner, you're looking at higher amounts of deals that are all cash, higher values in general, better tax treatment. I mean, it was a noteworthy difference, and it all goes back to, I think, kind of this last one here. When we work as an intermediary, we're working with one buyer and one seller and helping them get their deal figured out. It's a very different experience, and you'll never actually get to go through it both ways. Maybe, but not on purpose. Where you go through and do a deal with just one person, maybe a peer or a friend that you know, and then time machine, we go back and we do that same deal, but instead of just a one-on-one negotiation, now we actually have, let's say, 54 people that are interested, and we narrow that down to 5 or 6 that are really good candidates. They're bankable, they're committed to trying to get this deal figured out, and they all make offers. It's not surprising then that as we're able to help negotiate for you, let's say hypothetically, that we are able to get better values and more cash and better tax treatment because we're able to squeeze more out of the deal than you would do on your own. So it was noteworthy as we looked at the two data sets, both in our data as well as others. When there was an advocate involved, it was a very different deal. So let's look at some of the interesting numbers from 2019. This covers a couple of just general data points that I found really interesting. One, and we'll go deeper into this, the buyer to seller ratio, which I shared, 54-1, 54 buyers for every seller nationwide. Average buyer age, 45. We'll get that question periodically. Highest recurring multiple in 2018 and 19 actually was 5.17. That is a very, very high multiple. Up over the last couple of years pretty significantly. You'll see the data set later. I'll be sharing what the range of multiples are. This would fall into the outlier category for sure, but deals like this happen every single year. We don't have a lot of time to get into the why of it, but I would tell you deals happen at the 4 and the 5 times range in a limited number of circumstances, and usually when there's a tremendous amount of new business to be done that wasn't already on the books. A lot of A-share books of business, for example, will sell at a higher multiple because of what the buyer will do with the deal post-closing. You'll see where you've got documented, track record of converting 401k rollovers, for example, and we know what's coming. That's where you can start to justify some of these higher values, and not just potential. I mean, potential is only a small part of it. You also have just good practices that will get into the higher ranges. Deals with clawbacks. This one went up a lot, and it had historically been trending down. And I think this ties back to what's happening out there in the equity markets. I mean, look at the S&P and the Dow. I mean, all of those are up for sure over the last 5-10 years. But buyers who we talk to a lot are worried there could be a correction at some point. And I think as a result, you're seeing the deals with clawbacks starting to creep back up. Where last year we were, I believe, at 48%, so a little below half the deals had no clawback. Now here we are at, I would say the vast majority, 67% of all the deals had some kind of clawback or escrow clause built in. And then you can see the all cash deals I mentioned, 56% of our deals, all cash. And then average size of those practices sold right around 70 million. So I want to pause here and tee up a quick question. As we think back over what's been happening out there for both John and Dustin, I'll start with you, John, but just looking at general trends in the industry, 2019, looking ahead at 2020. John, anything noteworthy that Live Oak, is seeing that you can share with the audience?
Thanks, David. Yeah, there are a few things that we're beginning to see more of. I would say we've seen a significant uptick in partial acquisitions, whether that's a generation 2 buying a percentage of the business within a generation 1, or it might be an advisor who's maybe wanting to sell out their C&D clients. Sometimes they'll use the term deleverage the book or take some chips off the table, but clearly we're seeing this uptick in this kind of percentage sale or stage succession. Another one we're seeing, of course, you've already mentioned it, is just this big rush to the 100% financing and leveraging the escrow for the clawback. Nearly every deal that we see now are kind of structured that way, sort of the full price, all cash. And I think we may get into it later, but it seems to me that's not going to, terms aren't going to be the differentiator anymore. It's going to have to be some other things that'll differentiate you, but that seems to be a thing. And then I'd say we're seeing larger geography, people stretching across states. So it's no longer just looking for that advisor within your town, but it looks like there are deals that are being done that are stretching across the states. And sadly, the last one is we've seen a significant uptick in sales due to death and unfortunately dementia. We saw a very big uptick from 2018 to 2019, and I think we're just beginning to show our age within our industry on that point.
Yeah, and I'd kind of come in with some comments regarding, I'd echo what John has to say. We're seeing a lot of the same trends, but one thing regarding deal structure that we're seeing that's a little different than the past is, one, you do see the increasing multiples. Two, due to this, I think it is feeding the need for these buyers to come in and borrow 100%, because historical deal structures, when you look back in 2014, 15, 16, involved seller financing. Maybe that was over a 3 to 5 year period. So under that scenario, cash flow is obviously compressed with a larger amount of debt compressed over a shorter term. And therefore, as multiples increase, there's really a need to see these escrow or bank holdback options being offered, because we are also seeing some buyers in the market, really feel almost not necessarily, I would call it a need to grow by way of acquisition versus organic growth. And we are seeing some deals that get done that are, in my opinion, shouldn't be done in terms of the pricing, because, if you're a buyer in the market and you have limited amounts of established cash flow in your existing business, paying a 3-4 times multiple and not giving consideration to the unexpected, being the market itself and when it takes a turn, I think puts people in a unique position. So with that taking place, it'll really be interesting to see where the market plays out and how some of these deals hold up long term if we do see a market correction out in the next year or two.
You said something interesting. If I could mention it, Dustin, I think it's true. Whether you have a PPC Loans or a Live Oak Bank in your corner, and I think, David, you would agree with this. It's just, you're right. There are some deals that shouldn't be done, and having a professional really doing the cash flow analysis to really determine the affordability of the deal, I think it's really important. And I think, like I said, you would get that with Dustin or myself. So I think that's just sort of an important aspect that you brought up, Dustin, that I just wanted to emphasize as well.
Yeah, no, good points. We had a couple of questions that came in while you were talking that I thought I would ask or answer, and then ask the two of you as well. One of them, I'm going to direct this to you, John, just because I've heard you answer it before. And this is from Nicola. Question is, how would you address the concern that organic growth suffers when you acquire or merge with another firm? John, you've been in both the lending and practice management role. What are your thoughts?
Actually, that's a really good question. I think a lot of times the thought is, well, if I'm going to spend all my time, energy, effort on transitioning this book, there's no time available to do any kind of organic growth. So it's an either or. What I would submit to you, it's actually a both and. And here's what I mean by that. Your most organic growth takes place with referrals. We've always said that's the best way to grow organically. What happens is, when you've increased your plot of land, if you will, your ability to farm referrals, they actually go up. The other thing we see is we've done some analysis ourselves, and we know that in the second year, attrition goes to 120%. Yeah, 20% greater. And in the third year, it goes between 130 and 140%. And really what's happening is that I believe sometimes sellers do sell in place, and they really aren't working that book very hard. And here comes a new person in, and they're active, and they find opportunities within that book. So we see it really as a both and on the client acquisition side with referrals, and deepening the wallet, just being active and serving the clients well and finding opportunities within the book.
I guess my comment would be, one thing that I think this is one of those areas where the best quality buyers or firms separate themselves from others, because one doesn't have to suffer, the acquisition growth doesn't have to impact the organic growth. And that's where you see some of the firms, as they grow themselves prior to doing acquisitions, will actually bring on an individual, leverage someone like SRG to kind of assist in this search. So they're not pulling the people in their firm who are focused on new business, servicing existing clients, and have to deal with organic growth suffering. So, if it's a long-term goal to pursue that acquisition growth opportunity, there is the ability to look at, hey, do I need to potentially bring someone on so that I don't have to limit my hours as the owner or limit my junior advisor's hours pursuing new business, so that we can go out and meet sellers? Because as you can see by the numbers that David puts up, we have 54 buyers to every seller. Competition is higher than ever. And having somebody who can focus and maybe go out and talk to various sellers, I think can help limit the impact those acquisitions have on your organic growth.
Yeah, no, great points. I appreciate it from both of you. And we honestly, we see the same things. We check in much like I know the lenders do, 6 months, 12 months, 24 months after close. And our data shows the same thing. Frankly, the business grows as a result of the deal. We've got more questions that have come in. One that I know just ties back into this, deals with no clawbacks and the all cash deals that I just shared. And it's from Tom. And I think more of you have this question, so I'll ask it now. Do all cash deals with no escrow have a lower multiple? I would say in general, yes, conceptually, not always, but it really just goes back to balancing risk. And as you eliminate any contingency or clawback, whether it's a seller carried note with a clawback or an adjustment, whether it's an escrow with the contingent release of funds, either way, as soon as you eliminate that and the buyer takes on all the risk, unless there's really just no risk or very little, you tend to see the price be slightly depressed, which is why I think we're seeing more and more of these deals with the clawbacks built in. Because the seller, when they go through and evaluate 54 potential buyers, for example, and they zero in on the best 4 or 5, and then they pick the best offer from the best one, they're not really viewing a lot of risk in that deal anyway, so they're fine building in a clawback because they rarely ever need it, and the data seems to bear that out. But good question. So to get back to some of our content here, since we had another question that had come in that ties back to our next slide, I'll just move along here. And that is, looking at the sell side, what's the average seller look like from last year? And it's been pretty consistent. I certainly love input from Dustin or John if they have different perspectives, but I think theirs is probably pretty consistent given their data's in here. The average number of households sold, 162. You can get an idea of the size. There's certainly some variation in this. I think eliminating outliers, we had a pretty normal range of anywhere between like 1,500 as a revenue per client. A few really good practices got up into the $8,000 and $10,000 range as revenue per client. Employees, let's call it 2, 1 owner, and they've been in business almost 30 years. The question that I had that ties back into this was related to the owner's age when they sell. That one's been interesting in that it just keeps getting a little bit younger each year, partly I think tied to the fact that with the bank financing, you've got more available cash flow. With more available cash flow, we can keep the seller involved longer and keep their staff. If we can keep the seller involved longer, then they can take their chips off the table earlier, eliminate their risk, and it kind of becomes a win-win. So average seller age has been trending down. I think now we're in the early 60s pretty consistently. Trust me, we still have the 70 and 75-year-old advisor who decides to finally sell the business, but the trend has definitely been doing that deal a lot earlier. Other noteworthy trend, and this leads back to the bank financing stuff that I want to get more input from PPC Loan and Live Oak on, and that is, what's the average deal actually look like? And then followed up by why it doesn't matter. So here's our average. 81% cash down, 19% seller financed is the average deal. The financing period here, somewhere right around, let's call it 5 years, 4% interest, and again, that's 67% of these deals having a contingency built in. Why it doesn't matter? Because ultimately, when you really dig into it and say, okay, when we look at the comparable sales, do these deals actually look like? None of them really look like this average deal. They were either in the no external lending category, where they brought cash to the table, for example, and that was something more like 38%, you can see here, cash down, and then the balance seller finance, a big portion of it. Looks a lot like the deals from 5 and 10 years ago. And then you got the majority of the deals here that are borrowing effectively as much of the money as they can get access to. So here you're seeing that trend towards the all cash deal. So the average when you have external bank financing involved is 88% cash down, almost 90. And then some small sliver here being seller carried. In lots of different ways that this happens. Like I said, it could be a seller carried note, it could be money put into escrow, but it's some money held back for 12, maybe 36 months. So as we get into then trends, one of those versus the other, you can see the trend is towards that right-hand side, the bank finance deal, representing 85% of all the deals. That wasn't just in the data obviously provided by PPC and Live Oak, because of course theirs would be bank financed. Vast majority of our deals is stuff that we had and other sources, broker dealers, custodians, and TAMPs. So like I said, a good cross section of data here, but the trend is definitely towards leveraging the external capital. John, I'm going to start with you, and I know you hate questions as a bank about rate because everyone always asks them, but you knew it was coming. From your perspective, John, everybody wants to know rate. So as you look at 2020, what are Live Oak's expectations around things like rate and term?
No, it's a really good question. Term is staying fairly stable. We do 10-year term, 10-year amort, and it's somewhat regulated by bank regulations. So I think that's going to stay where it's at. Rates follow Fed. I mean, that's just kind of the way it goes. And if you think about it, in 2018, the Fed raised rates 4 times. And if you asked an advisor back then, they always would say, oh, they will never go down. They're always going to go up. I heard that so many times. Well, 2019, the Feds dropped the rate 3 times, and interest rates followed that for bank financing. If you take a look out for 2020, it looks stable at this point. There's few economic risks on the horizon. Inflation is staying relatively low. If you pay attention to the Fed, they're not making many statements either that would support it going up or going down. So I would suspect it's going to stay stable for 2020. But as I always say, rates, they're going to go up and they're going to go down. One of the things that I also say, I know rates are important and people key in on that, but for a cash flow goodwill business, cash flow is what matters. And what drives cash flow really isn't rate, it's term. So it's kind of back to what the evidence is in the data, what it already reveals is the holy grail usually is to get as much of the deal as you can on as long a term as you can, but with as much flexibility as you can in the deal. That gets you great cash flow. Rate impacts it a little bit, but not nearly as much as term. That's what I would say about where we think rates and terms are going in 2020.
Wonderful. Dustin, anything to add to that?
Not too much. I mean, I don't see any material changes to the upside or downside in terms of the direction of rates. I think for most advisors, most lenders in the market, you're going to be looking at rates in the sixes. They could be fixed, they could be floating. I think that's where we're at today for most everybody involved. But again, I think most lenders are in the market knowing that, there is some level of risk-based pricing involved. There's a large difference in how we price an advisor who's 20 million in assets looking to buy 80 million in assets versus an advisor that's 200 million in assets looking to buy 50 million in assets. What does cash flow look like, as John mentioned? And just as important to cash flow, what does the personal financial strength of the applicant look like? So those things will ultimately feed into rates, but I don't expect any major changes to the upside or downside.
Perfect. Yeah, good to hear. So then getting into the actual types of financing, and you can see here, or you will see here anyway, why we invited both PPC Loan, Dustin, and Live Oak Bank, John, join us. When you dig into it and say, okay, so 85% of all of the deals were leveraging external financing capital, what kind of capital were they getting it from? So on the left-hand side, you've got conventional sources. On the right-hand side, you have the SBA guaranteed portion. And I will let, obviously, Dustin and John both share their perspective since they are the ones actually lending the money. But these are your two primary options for businesses, RIAs being bought and sold below $1 billion. There's no real private equity being leveraged here, at least not a material amount that would show up in our stats. So I'll start with you, John. Can you share maybe a little bit about the actual type of financing that you all offer? Because I know you generally kind of get pigeonholed as an SBA lender, and it's a good option, I think, in most cases. But I know you guys provide a little bit more than that, right?
Yeah, we do. We do SBA, we do conventional, we do tri-party, we do fixed, we do variable rates. Put a graph, put a matrix together and pick a box. What I would say is that they tend to underwrite about the same. For us, SBA tends to be a little bit lower rate and a little bit higher term. The big difference, I think, is if there ever is a default, how draconian is it going to be? And, for the advisor, if it is an SBA, that's probably the most gentle glide path that you could have if something goes bump in the night. But that's where I think the major differences come in is hopefully in the unlikely event, as they say in the airline industry, in the unlikely event that you would default, it's a little bit gentler with the SBA. Okay,
thank you. And Dustin, same question to you, please.
Yeah, I mean, conventional financing, one thing I've always highlighted is the flexibility that surrounds it. The conventional products available in the market are going to be typically designed by the bank offering that conventional product, whether it's PPC or Live Oak, versus under an SBA loan, some limitations based on what the SBA requirements are for that specific need. Most importantly, I think where people miss the mark is, really putting all their eggs in one basket. Having a front-end conversation, maybe they take the time to have it with 2 or 3 lenders, apply with one, only to find out that they need to kind of restart with another lender. So just like anything, competition is going to favor the applicant or the borrower. And secondly, apply with 2 people, because one of the hardest things for us is picking up the pieces. when they've talked to another lender in the market, who maybe has just entered this business, maybe it's just an individual passing your loan request to a variety of banks. And next thing you know, you're 3, 4, 5 weeks down the road to find out bank wants to restructure your deal, bank declines your deal, and you have to go back to square one, start the process with a new lender, and you're probably starting to burn goodwill with your seller if you're having to move the closing date back. So, outside of that phone call, get some offers from multiple lenders so you can understand what the terms, the covenants, and all aspects of that financing offer look like.
Yeah, I know, probably, and it's funny, because obviously we've got both of you here joining us, but I would hazard a guess that both of you would agree, if you've got a buyer, they've got a deal in the works, they really should be talking to two lenders, let's say PPC and Live Oak, for example, versus just putting all those eggs in one basket, which we always encourage folks, because the deal changes as you're negotiating it, the terms change, things change, it's a process, and sometimes what you thought the deal was when you started isn't where it ended up, and it may not fit perfectly with the lender that you started with. So anyway, just keep your options open. I think these are both good options that they shared. So to then carry on into the rest of the deal portion of the session, I want to also talk about taxes. I'll do it ever so briefly. But don't forget about the taxes when you're negotiating these deals. I'm going to share the multiples with you actually here on the next slide that we're seeing. But the big portions that you negotiate in these deals is price, terms, and taxes. So I'm going to talk about price. We've been talking about terms. This is the tax portion. So when you're negotiating a deal, the seller wants to pay no taxes. They'll settle for long-term capital gains. You as a buyer just want to make sure you can write this whole thing off. And frankly, you like to write it off as fast as you possibly can. So the way you control that isn't the payment terms. The way you control that is your tax allocation in your deal. And while every deal is a little different, that's my caveat here. I'm not your CPA and I don't want to ever be one. When you're negotiating your deal, you do want to make sure you have an agreement. If you're the buyer, you want it with the seller and their CPA. If you're the seller, you want it with the buyer and their CPA, because you need to make sure when this deal is done that everybody's on the same page with, of course, price and terms, but also the taxes. And while consulting is a big part of every deal, the restrictive covenants, the non-compete, non-solicitation is a part of most deals. And then obviously the clients is the lion's share. Sometimes you've got tangible assets that are involved. Occasionally, we're dealing with a death and disability situation where you obviously don't have any consulting involved. So every deal is a little different. Some deals have longer transition consulting required, might be more than 5%. If you're doing a $5 million deal as a sale price, we probably don't need to allocate 5% of $5 million for 12 months of post-closing assistance. But this is a good starting place, especially because usually when you go talk to your CPA for the first time, when you're doing a deal, they won't have ever done this before. So it's nice to give them a good primer. We've got more resources on this, some good deliverables, but this is a good starting place and it gives you a good average from last year on what the typical tax allocation looked like. So let's get into the multiples. We get this question a lot. We got a lot of questions that have already come in, and that is, what are the multiples and what are they applied to? So I'm going to share with you today top line multiples. I will acknowledge there's a time and a place for earnings-based multiples, multiples of EBITDA or EBOC, multiples of net income, however we want to get there. But those are oftentimes used for larger businesses where we're really acquiring a business. All of its revenue, all of its overhead, we've got to replace the owner potentially, sometimes not. There it makes a lot of sense to base the value and use a multiple of earnings because that's what's being transacted. But in most cases, when we talk about deals that Succession Resource Group has data on and worked on, Live Oak Bank and PPC Loan, more often than not, what's really happening is they're buying and selling revenue, clients, and assets. So as a result, the math as far as multiples go gets a little bit simpler. You've got non-recurring multiples along the top here, trending up last year to 2.72, up a little bit you can see over the year prior. And then the non-recurring, the commissionable stuff is down here at the bottom, flattened out a little bit, but it's been trending down. It's always been around a 1x multiple. These are your average multiples for 2019. So if you were, let's say, a fee-only RIA and you made $1 million in fees, retainer or traditional 1% on managed money model, you would be worth on average $2.72 million. If we throw in, let's say, a broker dealer, we're still all fees or all recurring, but now we've got a 10% haircut, 90% payout, we're going to be 2.72 on the 90% that you receive, your gross revenue, because that's what a buyer would have access to and the ability to take over. So hopefully that answers that. We had a couple of questions that had come in with respect to A, what the multiples were for 2019, which we've shared, both recurring and the non-recurring separately, because they are valued very differently, no surprise. But also what we apply these multiples to, because I know we see it a lot out there in the industry where you'll have a seller come back to a buyer who we're talking to and they say, well, you're misinformed, buyer, because I read an article yesterday that talked about an RIA deal that got done at 8 times. And they're not wrong, but 8 times what? 8 times earnings, because those very large kind of mega RIA and OSJ deals that get done, you really are buying earnings. So it makes sense that you'd use an earnings-based multiple, which are often much higher. So that gets into the multiples, but what you don't have a lot of context looking at this slide is, are all the deals getting done at 2.72 and 0.88? No is the short answer. You can see here the dispersion on the low side, and this is just the recurring revenue multiple, mind you. 1.6 on the low end, up to pretty consistently, you can see 4.3% of the data set fell into that 4.4 to 4.8 category. So an interesting dispersion, just knowing that the average is somewhere, right about here. But no two practices are created equal. And I know that's not lost on any of you, given that you saw I published the data, and the vast majority of you that we invited and that attended today are business owners. And as a business owner, of course, we care about what the value is, and we care about how we get to that value. So then we have to start looking at things like the age of the clients, location of the practice, revenue per client, which I shared with you earlier. There's a lot of different factors that might drive a practice up in this range or down in this range. But the point is, the average is 2.72 on recurring, but it's a lot like knowing the average price per square foot of residential real estate in the US. Really interesting. I should know it for sure in terms of a benchmark, but you'd never buy or sell your home based on it. So this should help give you a little bit more informed opinion now that we know the average is 2.72 on recurring, but there's a lot of wiggle room both above and below that. What I thought was interesting here is tying this back to the financing. As we looked at the deals that were bank financed versus those that were not, very interesting trend, because I would tell you before the bank financing was really happening a lot, before Live Oak and PPC were lending money to advisors consistently and making it easy on them, the expectation was if I had an all cash deal and borrowed a bunch of money and put 80% cash down, industry values would go down. Time value of money, shifting of risk. But again, with the financing term, because PPC, Live Oak at the very least, as well as most of the others I'm aware of, they don't lend over 5 years. If they did, I think we'd be seeing 2.52 as a very similar number on the bank finance deals. But trend has actually been, those deals that are bank financed are getting more value out of the deal. And incidentally, I know not lost on anybody given the comments from both Dustin and John, that's because the buyer actually has more cash flow in the bank financed all cash deal. So let's flip over to the buy side now. Look at what's happening out there with the buyers. We get this question a lot. So I put together a dashboard that we look at a lot here internally. And this is all the information from a couple thousand buyer profiles. When we list practices, we have buyers complete a profile for us, so we know about them. Talk to the seller and screen. This is that data. So some highlights here. The frequency of those that have done acquisitions before, this keeps going up every single year, and not surprising, but you're looking at now more than half of the field has experience acquiring a business before. They've been doing it for more than 10 years. You can see the size of the businesses pretty evenly split, 51% with less than $1 million, 49% over. Political affiliations, shouldn't go there, but we did. The reason we put this in there is because we get a lot of buyer profiles that complete the data for us and they don't give us an answer here. And it's generally probably a good thing and a safe bet. The downside is it matters to the seller. Whether you like it or not, it does. They care about it, they ask about it. So when we don't know, well, we have to start with those that we do know. And you can see the trend here is if we were looking for a Democratic buyer, I might have some trouble. But they seem to probably be in the declined answer category. So when it comes to negotiating these deals, my point is not just your political affiliation, but it really is just about fit. Prior acquisition experience is great. Lots of experience in the industry is great, but you could have no experience, never have done a deal before, and just really hit it off with a seller, and the seller knows you're going to do fantastic with their clients. And I would tell you that is more important than your political affiliation. It's more important than years in business, prior acquisition experience, size of your firm. Only on the size of your firm might matter is when you get back to talking to the banks, trying to get the financing. If you don't have any production and you haven't been doing it very long, you may not be the most bankable buyer. But besides that, it really is mostly about the fit. So, Dustin, you've been doing this a long time for a lot of buyers. There's a lot of competition for practices. I know that's not lost on you. Strategies, tips you can share where you've seen your borrowers, your buyers be more successful than the general field?
Yeah, one thing that I think is important to point out is this previous acquisition experience. I think that figure could continue to grow because outside of price, as David mentioned, fit's going to be important. And part of that fit has to do with the buyer's capacity and ability to absorb those clients, and from a seller standpoint, provide the same level of service their clients have become accustomed to. So for those buyers who don't have acquisition experience, don't rule out doing something on the smaller side. If you need to go buy 20, 30, 40 million in assets, you don't have to go look for the biggest practice possible because, again, it may become more difficult to acquire, not only in the eyes of the seller, but also for your lender. So consider all options as you get moving forward because, we see it in our customers alone. I think it's north of 40% of our customers who have borrowed once actually have borrowed twice or more times from us. And I think that comes with experience and it allows them to better articulate their value proposition to a seller. So don't pass up on potentially smaller opportunities that could help you separate yourself down the road when you have a seller wanting to know, okay, well, why are you going to be the right fit for my clients and how has this worked in the past when you've integrated, retiring advisors practice into your existing practice?
Yeah, no, perfect. John, anything to share on that same point? I know you deal with a lot of buyers as well.
Yeah, you probably know what I'm going to share because I harp on it a lot. Yeah, particularly for sellers. I mean, we mentioned it earlier. Usually you're probably going to come in full price, all cash. That's not going to be the differentiator. I tend to group things into the 5 C's, and some of you have heard me talk about this before, but, and it takes preparation. If you're a buyer, you need to prepare so that you can demonstrate these. If you're a seller, you need to figure out how you can filter down from the 50 plus down to the real qualified buyers, perhaps through the 5 C's, but it's cultural fit. That's where you see things like, do you have a similar value proposition? Do you have a similar service philosophy? Do you have a similar product mix? Do you have a similar client database? That kind of stuff. Next one is character. Are you a person of honesty and integrity? How can you demonstrate that? It's very important for most sellers that they place their clients in the hands of a high quality individual. Next one is capability. Do you have the intellectual horsepower to deal with the most difficult case in that book? And how can you demonstrate that? Is it alphabet soup after your name? Is it showing some of the cases you've done in the past? And the next one, Destin, you mentioned this, it's capacity. And that is, do you and your staff, do you have the capacity to take on, say, 200 clients overnight and serve them well? So do you have workflows in place? Are they automated to your contact management system? Have you segmented your book? Do you have a differentiated service model by segment? Do you have the right people with the right skills in the right position? All that sort of stuff. And the last one is capital. You need to make sure that you've identified how you're going to pay for the deal, whether it's you've got a big pile of cash or you're going to come talk to Dustin or myself. But those 5 C's, I feel, really help to set you apart with a seller. And I know,
I'd
David,
add
that's
one.
really familiar to you.
Yep. Yeah, Dustin?
I'd add one thing to that too. I think a lot of people don't realize the value in getting involved with the lender early. I've seen so many deals structured and only to find out each and every lender they talk to wants to do something different. So at minimum, start engaging a lender early, just like you would someone like SRG, because there's so many variables that go into putting a deal together, finally getting a seller to the point where they actually want to sell. I mean, we've worked with people who've been talking to the same seller for 3, 4, 5 years. And next thing you know, they structure a deal, make promises to a seller that they can't meet, and ultimately, end up burning a lot of goodwill with that individual. So, engage as many resources you can early on in the front. And the last thing I'd say is, the deals, some of the deals I see that get done that I always wonder why the buyer has this philosophy. But if you can come in and you see the opportunity to grow a business, I'm not interested in financing a price that is where you see the value of the firm in 3, 4, 5 years. It's like, well, they're doing, they've got 100 million in assets and they're doing 300,000 in recurring. So if I can generate 700,000 in recurring, it'll be worth 2 million in 5 years. So that's what the seller and I have agreed to. And I think those are some of the non-advocated deals by SRG, but we see some stuff happening that, it surprises me. And I think some of those deals that they've agreed upon or why they're looking at paying a price they're paying, they might have been able to negotiate a better deal by engaging multiple lenders, talking through who's going to be a good partner long-term, or, having someone like SRG represent them as a buyer.
Yeah, great insights. So let's take what we've been talking about and move it into our predictions. So we talked a lot about what happened in 2019 and even looking over the last couple of years. I think we've got some good perspective now. Let's get out our crystal balls. We'll play the financial advisor and we're going to make our predictions for 2020, as well as even beyond that. And again, more to come on the decade to come. We've got a whole session dedicated to it. Industry trends and predictions. I'll share my first couple, and then I certainly look forward to hearing from both Dustin and John on what they are seeing and thinking will come. I'm expecting, again, the data supports these predictions, so they're not really predictions so much. Down payments, 100% financing, just going to continue to be the norm. Again, at least as long as this interest rate environment continues. Maybe someday, hopefully not 2020, when interest rates are at 9%, 10% at prime, for example, maybe you'll see some seller financing start to creep back in. But until then, the cost of capital is just too darn attractive. It's too easy to get the money, and you can get too much of it. Frankly, you just don't need to bother the seller, and that just means more deals are getting done, which is leading to my next one, seller inventory. We've got more details on this coming in our press release, but we got the graying of the industry. The general population of advisors is getting a little bit older. Doesn't matter what study you cite. I think the most recent one was from the FPA, but the propensity of professional planners, financial advisors, to actually have a succession plan, like a written one in place, it's like maybe 20 or 30%, and that's probably being generous. So you've got 3/4 of the industry that just doesn't have a plan. They're getting older. Still capable of doing the job for sure, but they're getting closer and closer to retirement with no exit strategy. So I think depending on what happens in the equity markets, if we see the markets in 2020 take a big dip, well, you can imagine what's going to happen. But I know both John, Dustin, myself all worked through the Great Recession. If the same thing happens, you're likely to see deal volume kind of pause momentarily until you see a little bit of light at the end of the tunnel, a little bit of a rebound, and then you're going to see the inventory of practices looking for a pretty quick exit, not a fire sale, but a quicker exit, wanting to sell the business now when they weren't planning on it 12 or 24 months ago. That number is going to go up pretty significantly. So for those of you buyers that have asked the question, and I've seen a couple of you, where do we find these deals? Well, the short answer is stand by. I mean, you can look at our website. We have a tab right at the top labeled sellers. You can check out some of our peers, competitors, FP transitions, list practices. There's a few other ones out there from time to time that list things, but in general, there are a good amount of deals happening now. It has picked up in terms of inventory every single year historically, but I think you come out of another recession and you're going to see that volume increase significantly, where the job just gets a lot harder, combined with continuing ed and compliance and all the other things you get to deal with as a day-to-day. I think 2020, you're going to keep seeing more of this, and it could be a lot more. Practice values, despite the laws of supply and demand, practice values are just going to keep going up, mainly because I still think they're undervalued. And the data seems to support this prediction as well, in that I would guess in the next 2-3 years, you're going to see the average multiple probably right around 3 times. There are some of our broker-dealer partners that are very system and process oriented as an entire firm, but still independent. Their books of business are already trading at a 3 times multiple. So it's happening already. And you can see based on my distribution chart that I showed you, the trend is definitely, it's shifting towards that 3 times number. But the nice thing is we don't have to bust out our HP or a spreadsheet. The deal still cash flows. I mean, it literally cash flows from day one when you can leverage the capital that's available from partners like PPC Loan, Live Oak Bank. So those are my predictions. Longer term, I've already touched on a little bit. So as you look at my longer term predictions, a few of them that I haven't shared specifically, but we'll share in our upcoming webinar. I want to turn the mic back over for one more second to Dustin and John. Dustin, your thoughts as you look at the future, next year, next 10 years? Oh, you're muted, sir.
I think I would agree with most of the points you made. I do see volume increasing. The availability of capital has been one of the, I think, huge reasons more sellers are willing to come to market. Looking back before capital was available, the seller could easily say, well, why would I give you my profitability to repay me over the next 3 to 5 years when I can likely make more money than that over that same time frame? So with the availability of capital, you have more sellers coming to market. But I think, if you're looking out and expect that at some point in the next few years, there will be some level of a market correction. And I'd call it something significant, maybe 15, 20%, maybe slightly higher. I think for buyers who understand and have a good value proposition, they're going to see a large amount of opportunity. And there's going to be a few reasons for this. One, a lot of sellers will decide that, okay, I waited too long, but I don't want to deal with another 2008 and all the service work involved. And they'll be looking to hang up their hat. Huge opportunity for buyers. Two, I think with some of the deals that are getting done, one of the trend could be problem loans that banks experience. And you're going to see less capital available during a time like that. So understand that, the lender in which you partner with, could be the big difference in your ability to continue to grow even in a down market. I hear a lot of capital sources in the market where it might be brokers and different things. And they like to point out that, our value proposition is we're the advisor for advisors, or we're really looking for the best bank terms for you. And I would agree, they are looking for the best bank terms for you, but they're not looking to see if you're doing the best deal with the seller. And we've seen some issues pop up in terms of people trying to get us to refinance transactions because they're having cash flow problems. And I think that's an area where understanding who you're partnering with can make a big difference long term if you do have a strategy to do multiple acquisitions over the next 5 to 10 years.
Yeah, great insights.
I would agree with you, Dustin. And I do think, just that point of dealing with a high quality bank, if they have concerns, going to a low quality bank that's willing to do it doesn't necessarily solve the problem. So I just want to kind of keep that in mind. I would say I know we need to wrap up, David, but in addition, I'd say in the future, uptick in business, I think you're going to see flexibility, more flexibility. Most sellers have this mindset of it has to be a sell and leave. We haven't even broached sell and stay strategies. But when you think about the fact that right now markets are at a peak, they might be able to get the most value out of it that they ever could. Their clients aren't getting any older. We know a big discounting factor are clients turning age 70 and a half. So their client base usually isn't getting any younger. It's getting older. And if you think about where taxes are right now, with long-term capital gains, as low as it's ever been, it's like the Roth IRA conversion days. Maybe now's the time for sellers to lock in the value, but I know a lot of them emotionally aren't ready to go. And that's when you look at the sell and stay strategies. And that's a whole nother discussion, but I think that as sellers become more aware of that and as buyers talk about that, I think you're going to see a significant uptick, whether we have that market correction this year or not.
Yeah, no, great points. So now that we've gotten through the meat of the presentation here, let's deal with some of the questions that have come in. We have some really good ones here, a couple that I've already tried to answer while our panelists were kind enough to share their perspectives, but a couple of them that I think are questions most of you probably either are thinking about, or once I ask the question, you'll realize it's a good question. We get this one a lot. So first one I'll start with here, and I'll go ahead and take this one. It's from Jeremy. Jeremy, thanks for joining us again. Do internal equity sharing arrangements differ much from market sales? And the short answer is yes and no. If we're talking about a specific question that comes up a lot, and that is, do equity sharing arrangements internally differ in value from that of an external market sale? Short answer is, in general, yes, but not dramatically. In general, if you could sell off your business for $1 million and you've got an amazing internal person who'd like to buy in, and let's say they want to buy in 10% of your business. Well, if you know you could sell the business for $1 million and they want to buy 10% of it, why would you sell 10% for less than $100,000? Well, short answer is you probably wouldn't, unless we start talking about things like minority discounts. If I'm going to buy in 10% of your firm, I probably don't have a lot of control. And I might get a vote, but I'm going to be outvoted pretty much every single time. And then you have lack of marketability. Discount for lack of marketability, discount for lack of control are technically, two separate portions of a minority discount. And we've got both present. So I would say in general, we have to be sensitive to the topic of discounts from both the buyer's perspective, buying in, and the founder owner's perspective, because there isn't an easy, simple answer on this one. But the technical one is there shouldn't be a difference unless it's a fractional share. If it's a fractional share, then potentially. The next one is 100% teed up for Dustin and John. I'll start with you, Dustin, on this one, and that is, what are the usual collateral requirements on financing for the transaction?
Surprisingly, very limited. We take the business as collateral, and that's it. Outside of that, we do use life insurance as kind of a worst case scenario to protect from one of the few risks we can mitigate. Outside of that, we're not looking for collateral in the form of real estate, personal assets, anything of that sort. So the business is our core focus. And if the deal itself in terms of structure, cash flow, and credit quality of borrower don't meet our requirements, the deal doesn't get done despite however much debt-free real estate you might have.
Okay.
Yep, and I'd say the same thing. I mean, we'll file a UCC lien on the tangible assets in the business. So I tell folks, we usually have a lien on notepads and pens. So if you're going to go to the marketplace at your conference and you're going to talk to those wholesalers, talk to the ones with the good pens, because that's all Dustin and I are going to get. So please do that.
Next one, and I'll start by answering it, but I would like the perspective from both John and Dustin on this one. And the question comes from Thomas, and it is, how does a proven investment methodology and technology platform help in the valuation or the value of a business? Short version from our perspective, valuing and buying and selling these books of business and practices is, it really comes down to systems and processes that are repeatable by a buyer. And we've had practices that have amazing technology and they don't use it. We've had practices that have amazing technology and they use it. It is a well-oiled machine. And then we legitimately have practices that still have Rolodexes on their desk, and that's their CRM system. put yourself in a buyer's shoes. Which one are you going to pay more for? Which one is easier to do due diligence on, verify what you're buying? So from our perspective, the better technology that's used, the better systems, better processes, workflows, those things are all mission critical in maintaining continuity before closing and after closing. Dustin, your thoughts?
Yeah, I don't think it can hurt, obviously. I mean, it's one less thing for, a buyer to have to do in terms of making changes to the practice being acquired. But at the end of the day, I think the core focus comes down to the clients, the assets, and the revenue stream. That's what, in terms of what we see, probably accounts for 95% of the buyer's focus. Am I buying a group of clients that I can work with for the foreseeable future? Or I always like to quote Mark Tabergian, am I buying a depleting oil well because I've got 80% of the clients that are 80 years old and taking RMDs and ultimately have the risk of passing away and us not keeping those assets. So, I think it plays into it, but we do find that there's much more emphasis in other areas.
Okay. And John, I ask you last because while you sit in the seat of a lender now, for many years, you played a practice management consultant, and I know you'll have the most to say on this.
Well, I do think having good systems and processes boosts the value of your business. So from a practice management point of view, yes, I think, David, as a valuer, it might play into the valuation that you give. From a bank perspective, as Dustin and I've already talked about, it's cash flow, goodwill lending. Can the business afford the financing and afford the acquisition? It plays into the quality of the deal and might impact rate just a little bit. But we finance up to 100% of the value, David, that you assess that the practice is worth. And so to the extent that impacts the value, yes, it can sweeten the deal. But definitely good systems, good processes make for a much more attractive buy. Sometimes we do see them sell at a premium, and that's just fine as well. Oftentimes they'll still cash flow, even if they go beyond the valuation that was stated from SRG.
Excellent. Well, and with that one, that's a great one to wrap up with. We got a lot more questions that have come in, but we're already 10 minutes over, and I know you all have busy schedules. So we will make sure if there were questions that were more geared towards Dustin and John, that we have them respond. And then if it's something that we can answer, we'll get back to you just individually. I'd like to thank all of you for taking time out of your schedules here on a Tuesday to join us for our 2019 review and looking into 2020. I'd like to thank Dustin and John both for taking time out of your busy schedules to join us here and share your perspectives with the industry. We've had a couple of questions that I've tried to respond to related to the deck as well as the presentation. We have been recording this. We will make it available to you in case you want to listen to it or share it with any of your peers. We're more than happy to get that content out to you. Make sure you can make every decision with full information as you go into 2020 as it pertains to the value of your business. If you need to reach us, you can see our phone number is up there on the screen. You can get us at 503-427-9910. You can also visit us on the web. I know both Live Oak and PPC Loan both have their websites up and available. A ton of great information and content there, so check it out. With that, we're going to go ahead and wrap things up. Have a wonderful week, and if you need anything from any of the three of us, don't hesitate to reach out. Thanks.
Thanks, everyone.